All right. Hello, guys. Welcome to this video. In this video, I'm going to talk about how we take profits. Profits is something that I struggled with a lot because I was too much focused on the numbers that it says on my broker, right? I didn't focus on what I knew. I didn't focus on the liquidity that I knew because that's what we're trading. We're trading liquidity. We're hunting down liquidity. And liquidity is where the banks and institutions make their money. And we want to trade like them. We want to think like them. We want to trade like them. And we want to mark out or take profits where liquidity lies. All right. I'm just going to show you a short example here. There is liquidity lying everywhere, and this is where the market is most likely it has the highest probability of reversing to the other direction. So let's just show you. There's liquidity lying right here, right? What does the market do? The market goes up, takes out liquidity, and continues down. Okay, there's liquidity lying right here. What does the market do? The market goes up, takes out liquidity, and goes down, continues down. And again, where there's liquidity lying right here. What does the market do? The market goes up, takes out the liquidity, and continues down. I'm going to show it again. There is a high right here. The high means there is liquidity lying. This is where we make our money. So what does the market makers do in institutions? They go up, they take out they sweep. That's what liquidity sweep is called. They sweep the liquidity and then continue down. And what do we want to do? We want to mark out our take profits on these areas where it's highest probability for the market to reverse from because it just took liquidity and it's going to maybe reverse the other direction. If it's bullish, it's going to reverse bearish. If it's bearish, it's going to reverse bullish. And I get so like when I get so many comments regarding the take profits and the win rates and the stuff like this, like it didn't work for me. Like I don't have any static thing because the market doesn't care about how much risk reward I put in the market and how much risk reward you want from the market. The market doesn't care about us. So when people put a static, I want a 1 to 3 risk reward, and when that's the issue when this is happening when you have a static risk reward, 1 to 3, 1 to 2, the issue is that the market will come here and give you 1 pip away from your take profit and reverse and take you out. And you've risked $20, right? No, sorry. You've risked, let's say, $800 to gain $20 more. Is that fair? No. So that's why the risk reward, static risk reward, is not correct. Let me say that again. When you're at the end, yeah, look, you have 1 pip away. It happens to all of us. Yeah, you're 1 pip away, and it's like 20 bucks until you take the full profit, but you're up $800 on the position, and you've risked 700 and let's say you're gonna win $800. You risk $780 to gain $20. Is that is that a good risk? No. So that's why we don't use static risk rewards. We don't use static risk reward. Let me show you an example here. Where is this? Let me show you an example of how taking profit works. There's a taking profit system where you can use. I'm gonna go into the how to take the strategy more in depth, but just bear with me. So there's liquidity right here. What did the market do? The market swept liquidity right here, and we are waiting after the sweep of liquidity. We are waiting for a break of structure. There's a low created right here, and the body of this candle closed above. So what do? We wait for a fair value gap reaction, like it did right here. There's a gap, fair value gap. We take the entry right here, and we put our stop loss where? Either on this high or on this high. Why? Because most of the time the market usually consolidates on the stop loss area and then continues down. But that's to another video. And what do we want to do? I want to jump to a higher time frame because higher time frames hold higher liquidity power. Like I don't want to take So there's liquidity lying right here, right? I don't want to take profits right here. Why? Because we are on the 1 minute. There's a small amount of liquidity. Then again, it can still reverse from that area. But we want to go to the highest probability place where the banks and institutions have the most liquidity. They want to make the most money, right? That's the whole part of the game. So why do we take out the 1 minute where it has lower liquidity or and lower money for the banks to take than taking the 50-minute or the 1 hour? So I jump to the 50-minute, I zoom back down, and I see where is the low on that 50-minute. The low of the 50 minutes is right here because this is where the liquidity is lying. All right. And where's another 50-minute low? There's a 50-minute low lying right here. And what do I do on these areas? I have a template set. I put take profit here. And where's another take profit? There's another take profit right here on this area. And where's another take profit? There's another take profit right here on this area. All right. So if we jump back down to the 1 minute, what happens? This is what the market is doing. What happens? The market takes out the first liquidity, second, third, and fourth. And look, just look at what happens. This is we want to take profits on the areas where the market is more likely to reverse from. So the market most likely, because we are maybe you have a bearish trend, but still we want to put ourselves in a safe space, so we want to pay ourselves as quickly as possible outside of the liquidity. So the market might reverse from this area, continue up and take us out. But what do we want to do? We want to pay ourselves first from the liquidity. So it didn't reverse, so we take some part of the position off, and then we take another take profit here because there's a huge, not a huge, there's a high probability of the market to reverse from. Then again, this is 50-minute liquidities. And where does the most of the liquidity lie? On the higher time frame. And I can bet you that this liquidity is a 1 hour because it's the low. Yeah. See? This is so and this is the sell side liquidity also. This is the sell side low of the of the Asia session. So there's more liquidity lying right here. And what did the market do? We should look at that. It continued down. It take out the highest probability and the most liquidity that lies and continues up. Do you see? And there are people not even following the trend. There are people just taking small scalps on these areas. Highest probability liquidity sweep, 1 hour, and then they take the reverse. They take a trade right here. Take a trade right here. And what do they mark out when they take a trade? They mark out the liquidity, high time frame liquidity. So you could have made money from this area and this area. You see how it works? But we don't take these trades because it reverses the trend. And this is the take profit system that I'm using. I'm hunting down liquidity like the banks and institutions are doing. Hope you get some value out of this video and hope to see you on the next one. Have a good day.